Hello, and welcome to episode 1 of the Wall Street Conspiracy Theory Iceberg. For any of you that are unfamiliar with the format, it uses an iceberg to depict a complex topic. The tip of the iceberg starts with topics that most people are going to be familiar with. As you go deeper and deeper, more complexity arises until eventually you're just led to a lot of misinformation, false connections, and outright conspiracies. This particular iceberg I found about 4 years ago. I haven't seen anyone else cover it. So we'll go through every topic that's labeled on here briefly. Any of these are complex enough that I could make an entire video on them. So if there's any one in particular you'd like to see, leave a comment below, and I'd be happy to make something separate for you. We'll get kicked off with blue chip. Blue chips derive from casinos, with blue chips being high denomination or higher value chips. As far as it relates to companies in Wall Street, you can think of these as companies generally regarded as safe. They're going to be well known, they're going to be profitable, they're going to have consistent earnings. A few examples would be companies like Google, Apple, Coca-Cola, and Berkshire Hathaway. Next up, we have day trading and investing. There's going to be an important distinction between the two of these. When it comes to day trading, this is going to be more short-term focused. It's going to be more focused on technical analysis, which we'll talk about later in this series, whereas investing is going to be more focused on a long horizon. Day trading is probably what you think of when you see people selling courses online, or you see floor traders on Wall Street, the pictures of them with all their Bloomberg terminals. It's a lot higher risk. Most day traders don't have a long lifespan. The vast majority of them fail within the first few months, and they end up giving it up. Whereas with investing, there's a lot higher success rate just due to the time horizon associated with it and the type of people that choose to invest. With long-term investing, people are less looking at technical analysis and indicators, and they're more so looking at the fundamentals of a company's financials. So they'll look at things like how much debt does the company have, what does their statement of cash flows look like, how is it growing. For something like a tech company, you might be interested in their gross profit margins and their growth in user count or growth in time users spend on the platform. And these will all be used as a basis for making a long-term investment. Typically, people will either open up a large position up front and put down a large sum of money, or they'll continue buying into the stock or particular investment on a consistent basis. Then we have pattern day trade restrictions. So pattern day trade restrictions were introduced back in 2001. During the dot-com boom, you had a lot of people that were supposedly turning a couple $1,000s into hundreds of thousands of dollars or millions of dollars. And you also had people that were losing all of that money after they had those large gains. So the pattern day trade restriction was introduced, and it says that you can only make 3 day trades within a 5-day period. So an example of a day trade would be, I buy Apple at 10 a.m. for $100. At 11 a.m., I sell it for $101. That is 1 day trade. The caveat to getting around this restriction is you need a minimum account balance of $25,000. So the pattern day trade restriction was put in for the safety of the people so they don't lose more money. So if you really think about it, I'm not too sure if it's actually in the best interest of the people, but believe it or not, it is. And it just so happens to also benefit all of the brokerages, because now they'll have more assets under management. As anyone that wants to do a day trade, well, you can't do it with a couple $100s or a couple $1,000. You have to have a balance of $25,000. Next up, we have Robinhood. So Robinhood has gotten a lot of press over the past few years, some of it good, a lot of it not so good. You can really think of it as the Zoomer and millennial friendly brokerage. They were the first to really come in there and introduce zero fee, zero commission trading, which opened up investing to a lot of people, not just young people, but people of all ages can now do it at an affordable price. And it flipped the industry on its head. Since then, we've seen all the major brokerages switch to a zero commission, zero fee-based model. We see that with folks like Charles Schwab and Fidelity as well. So I would say what they've done has been a net good. However, there has been a lot of controversy with them, and they've had to pay several fines to both the SEC, FINRA, and the state of Massachusetts as well. So back in 2020, Robinhood was forced to pay a $65 million fine to the SEC. This fine had to do with payment for order flow. Since Robinhood doesn't charge commission or fees to execute trades, they still need to make money somehow, and the way they do that is payment for order flow. When you do a trade on Robinhood for either buying or selling, Robinhood is not the broker that executes that. They send that over to someone else that'll act in a principal capacity. Maybe it's Charles Schwab, maybe it's Fidelity, maybe it's TD. And for example, Charles Schwab will pay Robinhood to be the firm that executes that transaction. And users weren't getting the best prices, and they weren't making it clear to users what was happening with the payment for order flow. So they were, forced to pay this fine. And it really opened up the door for, these other broker dealers to be front running the Robinhood participants. So what you have is, maybe Apple's trading for $100 a share, and the best price is $100 flat, and TD says, well, we're going to charge you $100.10 because we can. And that's not allowed. That wasn't made clear to the users. That's why they had to pay the fine. In 2021, FINRA required Robinhood to pay a fine for $70 million. This had to do with them misleading customers about the risk associated with options trading. They ended up approving thousands, if not tens of thousands of users to trade options that really had no right to do so and just didn't know what they were signing up for, and resulted in a lot of losses for those individuals that ended up trading options. There was also a big controversy for Robinhood in 2020. They had a customer that unalived himself after the platform showed he had a negative $730,000 cash balance. This was one of the customers that was approved for trading options, and not just buying calls and buying puts, but they were approved to do complex strategies. And as part of these complex strategies, they were seemingly assigned a lot of stock that they didn't have the money to cover. What ended up happening was they truly didn't owe the money. They had only lost a few $1,000s. And Robinhood simply displayed that they had this negative cash balance, but this is something that Robinhood would have covered for them. Unfortunately, this was not made known to the customer until after the event had happened, and Robinhood reached out to them the following week. It resulted in the family suing Robinhood. I wasn't able to find anything online about what they received in restitution, but I would imagine that is what led to that $70 million fine from FINRA in 2021 about misleading customers regarding options and the risks associated with it. In 2025, they were also required to pay the SEC $45 million in fines for suspicious transactions. Additionally, the state of Massachusetts required them to pay a $7.5 million fine for gamification. Massachusetts said that Robinhood was encouraging risky behavior of their customers. An example would be they would show them emojis or confetti when they would participate in these risky behaviors. And if you've been on the platform, I'm sure you've seen some of the gamification that happens. I'd argue they've even branched off into gambling. The first time this was introduced was during the last election. They gave you the ability to bet on who would win the election. Afterwards, they also gave you the ability to bet on futures markets, they call it, or predictions markets for who would win NCAA championships. And recently, they've approved a lot of new customers for their credit card, and their credit card has a rewards points system. And as part of that system, you can even spend 1,000 rewards points to have the chance to win 5,000 rewards points, or maybe even up to 10,000 rewards points. Also, you have the option to get, a bad outcome for that gamble, if you will. You could receive something like 4% off of your next trip at Target when you're already getting 3% cash back on everything. Lastly, with Robinhood, you have the whole GameStop debacle. There's plenty of videos online if you want to learn about it in more detail. In short, what happened was there were a lot of users on Robinhood that were buying GameStop. There was short selling going on. We'll talk about short selling later in the series, but there were more shares short than there were shares outstanding for the company, and this can lead to what's called a short squeeze, where the price surges and the institutions or people that are shorting have to cover. They have to buy the stock so they don't lose an infinite amount of money by shorting it, and it hurt a lot of major hedge funds. Citadel was one of them. And Robinhood's solution to their user base refusing to sell and buying as much GameStop as possible to try and crush the market makers, the large hedge funds, their response was to just turn off the buy button and make it to where their users could only sell the stocks. This is something that led to a success for the short sellers and all the institutions that had positions against GameStop, and it led to a lot of losses for people that were long GameStop and they were, trying to win against the big guys. This was actually called out by a few different politicians, and it gained them a lot of backlash, also gave them a lot of publicity, and in the past few years, it's really just been swept under the rug, and their user base still continues to work with them. Then we have insider trading. So insider trading is going to be trading based on material, non-public information. So both sides are going to be at fault here. They're going to be guilty during an insider trade. So you have two parties on an insider trade. You have the person that has the insider information and they give it to someone. That person is, committing a crime. And the person that trades on that information is also committing a crime as well. Both of those people will ideally be charged and potentially arrested for that. However, insider trading happens all the time. It's really hard for the SEC to spot everyone that does it. So a lot of people end up getting away with it. Hypothetically, an example of insider trading would be an executive from Experian knowing that they had a massive data breach. And before they release that news to the public, they go ahead and sell their own shares of stock. Maybe they tell their brother and their sister-in-law to sell their shares of stock. That way they're not affected by the downward pressure when the news actually breaks. Then we have ETFs. ETFs are going to be exchange-traded funds. You might think of these as something like index funds, but they can be a bit more complex than that. They're going to be open-ended and traded on exchanges. So the main types of index funds you probably think of are something like Vanguard Total Stock Market or SPY or QQQ, anything that tracks the major indexes. But you also have ones that can get pretty specific. So for example, you have something like LIT, LIT. It's a lithium ETF that tracks lithium mining companies, or you have BOTZ, BOTZ. This is an ETF that tracks robotics companies. So you can use these to get exposure to certain markets or certain subsets of markets if you would like, as well as the major indexes. The way ETFs make money is through expense ratios. So something like SPY is going to charge a very low expense ratio. It might be 0.09% or so, and that's just taken out of the price sometime throughout the year. Whereas something more niche like BOTZ, they might charge closer to 0.75% a year as their expense ratio. Moving along, we have 401ks. So 401ks are probably the most popular retirement vehicle. It's what most people with a corporate job are using for their retirement. But there's two types of 401ks. There are Roth 401ks and there are traditional 401ks. Traditional 401ks are set up to where you don't pay taxes on the money today. It grows tax deferred. And then at a later date, you will withdraw the money and the full amount is taxable as income. And we'll talk about some of the problems that can arise with that. You also have Roth 401ks. A Roth 401k allows you to take money that's already been taxed, put it in the retirement account. It'll grow tax deferred, and your distributions are tax-free. For most people, the Roth makes more sense. However, if you think that you will have a lower tax bracket in the future than you do today, you might want to stick with the traditional. One of the issues that arises with the 401k in general is people think this is the only way to have money to retire. So people that are really serious about saving, they might max this out for years, for 10, 20 years. And if you do this coming out of college, you can amass a good sum of money. The problem with that is you have people coming out of college making good money, maxing out their 401k from age 22 to 40. They're responsible with their finances. Let's say they buy a house that's affordable and they pay it off early. And they might only spend $30,000 or $40,000 a year. They have a couple $1,000,000 in a 401k and they want to retire early. Well, they can't because the 401k money can't be touched without paying taxes and penalties. The soonest you can touch that money is 59 and a half. So if you max this thing out from age 22 to 40 and you don't spend a lot of money and want to retire, you're going to be forced into the labor market for another 20 years. Additionally, with a traditional 401k specifically, there's what are called RMDs. So RMDs are required mandatory distributions, and these kick in at age 75. So this says at age 75, you effectively have to take at least 5% of your account balance out every year. So just divide the account balance by 20. That's what you have to take out every year. And like we said earlier, the traditional 401k, you're going to be paying income taxes on the full amount. So if you're maxing out a 401k, $23,000 a year plus contributions from age 22 to age 65, that's going to turn into $15 million. And when you do your RMD and you're forced to take 5% of that out, it's going to be $700,000, $800,000. You're just immediately going to get thrown at the top tax bracket. So one of the issues, again, with a 401k, it can keep you in the labor market longer than expected if you're a super saver. And then it's taxed at income. So if you really fill this thing up, you turn it into a lot of money, you're going to be punished for it compared to just having it in a taxable account. And you don't have any liquidity because you can't touch it until you're 59 and a half. Now, if you choose to do a Roth 401k, since you're taxed when you initially put the money in, it's taxable dollars that have been put into it. You don't owe any taxes at all, not capital gains or anything, when you take your distributions. There's also no RMDs. So if you're interested in a vehicle that will let you grow wealth and pass it down to your children or grandchildren, a Roth is going to be a lot better option for you than a traditional 401k, any retirement account for that matter. Moving on, we have NYSE, Nasdaq, TSX, and OTC. So NYSE is the New York Stock Exchange, also known as the American Stock Exchange. It's the largest stock exchange in the world. It's based on floor trading. So when you see on CNBC, you got the guys on the floor of Wall Street. They got Bloomberg terminals everywhere. They're screaming at each other. That's the New York Stock Exchange. Now, Nasdaq was founded in 1971, and it was founded as an electronic stock exchange. So rather than all of the trading happening on a floor, happening on paper, it established electronic trading. You might also be familiar with the Nasdaq 100. So this is going to be around 100 companies that are made up of non-financial companies. It's mostly tech companies. And this is similar to an index like the Dow or like the S&P or Russell 2000, where people tend to track it on a daily basis, and they might even track their performance against it. TSX is the Toronto Stock Exchange, and OTC is for over-the-counter. So over-the-counter trades are trades that happen off of exchanges. They're not happening on New York Stock Exchange, Nasdaq, or TSX. They're happening over-the-counter, potentially between two broker-dealers. So for example, let's say I have $5 billion worth of Apple stock I want to sell, and someone else has $5 billion worth of Apple stock they want to buy. We can do that transaction off of an exchange at an agreed price. That way we're not having to liquidate all of this on the open market and deal with price volatility. Next, we have Warren Buffett. I imagine most people know who Warren Buffett is. He's arguably the most famous investor of all time, undoubtedly a great investor. However, despite what you might think, he hasn't gotten the best returns out of anyone. Really, he's a lesson in the value of time and compound interest. Just the fact that he's been around for so long, he has been investing for so long, he's been able to amass so much wealth. He even talks about in his annual shareholder letter to Berkshire Hathaway about how most of his wealth has been created in the past few years. Reason being, that's just how compound interest works. It is logarithmic. He's considered a value investor. He doesn't really follow technical analysis or hop on momentum stocks. He buys stocks that he thinks are valuable. He thinks he can hold them for a long period of time. He has famously said that he doesn't want to buy a stock he thinks he ever has to sell. And you can see that with the stuff he owns. He owns Coca-Cola. He owns American Express. He owns Geico. All of these are part of Berkshire Hathaway's portfolio. And throughout the lifetime of Berkshire Hathaway, they've averaged about 14.7% annualized returns, which is substantially better than the S&P 500, which is set around 10% returns. And then we have dividends. So dividends are going to be distributions of earnings or profits that are given back to shareholders. There are two primary types of dividends you'll run across. That's going to be cash dividends and stock dividends. If you own any stocks yourself and you get a few pennies or maybe a few dollars for every share that you own, that is going to be a cash dividend. Every time you receive a cash dividend, it is a taxable event. It's taxed differently than capital gains, and it's taxed differently than income. The other type of dividend would be a stock dividend. So this causes dilution when instead of receiving dollars, you're receiving more shares of stock. Most of the people that are buying dividend stocks are those that are seeking income. They want consistent cash flow coming from the equities that they're buying rather than just relying on the price of it going up so that they can sell it to someone else later for a higher price. There's a guy named Tan Lu that we'll talk about later in this series, and he actually makes an argument that dividend-paying stocks are the only ones you should be buying, and every other stock is actually a Ponzi scheme. His logic on that's really interesting, so stick around and we'll cover that later. Then we have Forex. Forex stands for foreign exchange. If you've been around YouTube long enough, I'm sure you've seen the advertisements for the Forex traders that'll show you how to make millions of dollars. The reason you potentially could make this money is it is a highly leveraged market. You can have 100x leverage or 1000x leverage, and it has to do with speculation. It has to do with speculation by definition because it deals with currencies. So what you're doing is you're looking at the price of pairs of currencies, comparing them to one another, and betting they'll go either direction. Then we have Timothy Sykes. Timothy Sykes is the original stock guru. He's a penny stock guy that was selling courses back in the early 2000s. He supposedly took his bar mitzvah money, turned it into millions of dollars trading penny stocks, and then started selling courses on it. You can actually still buy his course today. It's like $160 or something online. And supposedly you can take a couple $1,000s. He'll teach you how to turn it into millions. And I imagine success like his is why they had to introduce the pattern day trade restrictions back in 2001. To wrap up the iceberg, we have bank brokerages. So bank brokerages offer a service to investors. It allows them to have access to a variety of different instruments. They facilitate trading. They might act in a broker capacity or a principal capacity where they'll connect you with other traders or other exchanges to make sure everything executes. They provide accounts for you so you can set up investment accounts, you can set up savings accounts, you can set up UPMA accounts, and they'll also offer options for you. That's going to wrap it up for level 1 of the iceberg. Stick around for level 2. Like, subscribe, and comment for any of these you'd like to see an individual video on.